Joe, can you hear me now?
Yeah, yes, we can.
Sorry. Well, welcome everybody. Just to introduce myself, my name's Simon Douglas. I'm a barrister at Fivestone Buildings. I'm also an academic. I teach trusts and capital taxes at Oxford University. And today I'm going to be talking about tax issues for personal representatives. So perhaps it's helpful to start by talking about, explaining what I'm not talking about. I'm not going to be talking about any type of estate planning or tax efficient will drafting. In essence, any tax issues that arise before a testator's death. I'm really going to be talking about issues or tax issues which can arise during the period of administration and specifically concern the personal representatives. So here's the contents of this morning's talk. I'm going to be, the first three topics are to do with capital gains tax. We're just going to start by looking at how capital gains tax works on death. You're all probably familiar with the basic rules, but in case you're new to this area, I'll just give a very brief introduction. And then we're going to be looking at what happens when personal representatives try to sell assets in an estate and how that can trigger capital gains tax charges. And then we're going to look at the qua legatee exception. So when assets where assets are transferred to a legatee and how that works from a capital gains tax perspective. And then we're going to look at a couple of IHT issues concerning post-death variations and disclaimers. So capital gains tax on death, how does it work? Well, the general principle is that death does not trigger a charge to capital gains tax. The reason for that is that when a person dies, their estate is typically subject to inheritance tax, which is a charge upon that person's capital assets. So if you were to subject it to capital gains tax as well, you would effectively be taxing the capital twice over. And the way in which the CGT exemption works on death is through what's sometimes referred to as the Death Uplift. And this can be found in section 62 of the Taxation of Chargeable Gains Act 1992. And the way the Death Uplift works is that the rule provides that where a person dies, their personal representatives, so their executor, if they've left a will and named executors, or administrator in other cases, they will acquire the deceased person's assets at their market value, but without triggering a charge to capital gains tax. And that's very advantageous because what it does is it washes out any capital gains. So just to give an example as to how this works, let's take the example of Barry, and let's say that Barry purchased a painting in 2010 for £60,000. And let's say that Barry then dies in 2018 when the value of the painting has increased by £40,000. So it's worth £100,000 on his death. Now under section 62, Barry's personal representatives will acquire the painting at its market value at the point of Barry's death. So their acquisition cost is £100,000. And importantly, they don't pay any capital gains tax upon the gains that are realized at that point. So the gains of £40,000 are washed out at that stage. So that's how the CGT Death Uplift works. And just a note of warning here, the Chancellor Rishi Sunak asked the Office of Tax Simplification to look into CGT and in particular reliefs and exemptions earlier this summer. As you might have guessed, the Chancellor is in desperate need to raise revenue somewhere. And these types of reliefs and exemptions are the things that the OTS are going to be looking at. So a possible reform that I've heard from a couple of quarters is that where you have an estate which is exempt from inheritance tax, either because of exempt transfers or various reliefs, then it's possible that they will suggest removing the CGT death uplift. So in other words, capital gains which are realized on death would then be taxable. So it's going to be interesting to see what happens to the rule in section 62 and whether the death uplift survives over the next couple of years or over the next year or two. So yes, the death of a person typically does not trigger a charge to capital gains tax. There are exceptions to that, and they typically arise where somebody has made a gift with a reservation of benefit. That someone in that scenario won't benefit from the death uplift, but we can talk about that later in discussion if anyone's got any questions. The normal rule is that there is no CGT triggered by death. I'm now going to talk about what happens when personal representatives attempt to sell assets that are in a deceased person's estate. Because what we've seen is that whilst capital gains which accrue during a person's life are not chargeable on their death, if you have capital gains which accrue after that person's death and during the administration, then those gains will be chargeable to capital gains tax. So just to give an example of how that works, continuing with Barry's painting, we saw that Barry died in 2018 when the painting was worth £100,000, and the personal representatives acquired the painting for that value in 2018. But it's 2 years on now, the estate is still in administration, and the value of the painting has continued to rise. So it's now worth £130,000. So here we can see capital gains accruing post-death, and those gains are chargeable to capital gains tax. So if the personal representatives were to sell the painting this year, well then there would be some capital gains tax to pay, because you would therefore be realising chargeable gains of £30,000. So that's how capital gains issues can arise during administration. It's because gains which accrue after death are chargeable. And in practical terms, what that means is that where you have an estate which has been in administration for a very long time, then you need to start thinking carefully about the capital gains tax issues for when you complete administration. Because the longer the assets have been there in administration, the more likely it is that they're going to be showing gains. So if a personal representative has decided to sell the asset, well, if they've decided to sell the asset, they're going to trigger capital gains tax a charge to capital gains tax. And what they need to then therefore consider, is how best to use their annual allowance. So personal representatives have an annual allowance. In the current tax year, it's the same as the annual allowance for private individuals. So it's £12,300. So if you make a disposal of something which realises a gain, the first £12,300 will be exempt from capital gains tax. Now, although the personal representatives have the same allowance as a private individual, it's time limited. So they only have that allowance until the 5th of April of the year following the death, and then the 2 subsequent tax years. So if I were to die today, my personal representatives would have that exemption until the 5th of April of next year, and then the 2 following years. You then have to compare that with the position of the beneficiaries. So the beneficiaries of an estate, they also have the same allowance of £12,300, but they have that in each tax year. So there is no time limit. And importantly, beneficiaries can combine together and combine their allowances, which provides tax planning opportunities for the personal representative. So let's just look at how this works in practice. Let's say that we have a personal representative who has acquired assets, and during the course of administration, and I should say administration is not yet complete, those assets have increased in value by £50,000. And let's say that the personal representative needs to sell those assets for instance, in order to pay the IHT due upon the estate. The personal representative has two options. First, they could sell the assets directly to a purchaser. That will be a straightforward disposal, triggering a charge to capital gains tax. And because the assets have increased in value by £50,000, the first 12,300 is exempt, and the following, well, approximately £38,000 is going to be subject to CGT. And PRs, personal representatives, they pay CGT at the normal rates. So that's £20,000 for most assets, 20% for most assets and 28% if it's residential property. So that's the most straightforward option for the personal representative. But as you can see, if they go down this route, there is going to be some capital gains tax to be paid. An alternative for a personal representative is they could, as a first step, assent the assets to the beneficiaries who are entitled to that asset. So let's say that under the terms of the will, the four beneficiaries are the residuary beneficiaries, and they are entitled to this asset. What the personal representative could do is assent the asset to them, and what that means is that the asset is no longer required for the administration of the estate, and that the personal representative would hold it on a bare trust for the beneficiaries. Now, because he would be holding it upon a bare trust for the beneficiaries, and bare trusts are transparent for tax purposes, you would proceed then on the basis that the beneficiaries were the owners of this asset. So that when the personal representative then arranges for the sale of the asset to the purchaser, it's treated as a matter of law, as though it's the beneficiaries who are selling the asset to the purchaser. Now, in terms of which one is preferable, well, it really depends upon the circumstances. Specifically, it depends upon how the annual exemptions of the parties stack up against each other. I mean, let's say that this sale is occurring more than 3 years after the death of the testator. If that's the case, then the personal representative will no longer have an annual exemption. So the entire gain would be chargeable to capital gains tax. Whereas if you assent it to the beneficiaries first, so the sale is on their behalf, they could utilize their own annual exemptions, because of course their exemptions are not time limited. And importantly, I mean, in the little pictogram there, we've got 4 beneficiaries. What they can do is they can combine their annual exempt amounts into a single sum. And effectively, almost all of the gain then is covered by their annual allowance. So there's going to be very little capital gains tax to be paid. On the other hand, if you've got beneficiaries who have utilized their own annual allowances in that particular tax year, then the personal representative, it might be beneficial for them to use their own annual allowance. So the sale should be affected by them. So it really depends upon the circumstances. And just a quick note about what happens when administration is complete. Administration of an estate is, of course, complete when a personal representative is able to ascertain the value of the residue. So that's usually when they've paid off all of the debts and liabilities of the estate, and they can look at what's left and be confident that that is the residuary estate and that the residuary beneficiaries are absolutely entitled to it. So let's say that we've reached that point in the administration of the estate, and the only asset being held by the personal representative is this asset, which is showing gains of £50,000. If the personal representative then sells this asset to the purchaser, that sale will not be in the personal representative's capacity as executor or administrator. So it won't be treated as a sale from the estate to the purchaser. The estate, in a sense, no longer exists. The personal representative in this scenario has been transformed into a bare trustee. So the personal representative will be holding that asset on a bare trust for the beneficiaries. And that being the case, the sale by the personal representative will be treated as a sale by the beneficiaries. So you're effectively stuck with whatever annual allowances the beneficiaries have. The personal representative can no longer use theirs. So if you're advising somebody who is the personal representative of an estate, and there are assets in the estate which are showing a gain, then it's worthwhile thinking through these scenarios and thinking about how these various annual allowances can be used over the course of a couple of years from the testator's death. Let's now look at the qua legatee issue. So as we've seen, if a personal representative is holding assets which are showing a gain, which has accrued since the testator's death, then a disposal of that asset by the personal representative will typically trigger a charge to capital gains tax. An important exception to this is where the disposal is to someone who is a legatee under the deceased's estate. So this is the qua legatee rule. If somebody takes qua legatee as a legatee under the estate, then that disposal will not trigger a charge to capital gains tax. And importantly, that disposal is neutral for CGT purposes. So it doesn't realise a gain, and nor does it realise a loss. So in effect, the legatee acquires the asset at the personal representative's base cost. In other words, at the value at which the personal representative acquired the asset on the deceased's death. So what that then means, and I'm going to show you a diagram to illustrate this, is that when the legatee then sells the asset, they will at that point realize gains which have not only accrued during their ownership of the asset, but during the personal representative's ownership of the asset. So let's look at how this works. Let's say we've got a personal representative who acquires an asset, and the market value of the asset at the deceased's death is £100,000. And let's say that under the terms of the deceased's will, this particular asset was to go to a particular beneficiary. So there's a specific bequest of this asset to the beneficiary. And let's say that a couple of years after administration has started, the personal representative then is ready to assent this asset to the beneficiary. So they assent it to, well, let's say we've got multiple beneficiaries here. So they assent it to the beneficiaries. And let's say that in the 2 years during the course of administration, this asset has increased in value by £30,000. So by the point at which the asset is assented to the beneficiaries, there is a gain of £30,000. Now, typically, if a personal representative disposes of an asset, that will trigger a charge to capital gains tax. This situation is different here, and it's to do with the capacity in which these disponees acquire the asset. They're acquiring them under the terms of the will. And because they're acquiring them in that capacity, that does not trigger a charge to capital gains tax. But equally, you don't have anything similar to a death uplift here. It's CGT neutral. So what that means is that they will acquire this asset not at its value when it's assented to them, but at the personal representative's base cost. So in other words, that's £100,000. Now, what that then means is that should the beneficiaries sell this asset in the future, so let's say they sell it 2 years later to a purchaser, where the asset has increased by another £20,000, that is going to trigger a charge to capital gains tax. But the charge is not on the increase between the assent value and the purchase price. Rather, the charge is upon the increase between the death value and the purchase price. So at that point, gains of £50,000 are realised, and that's what they will be paying capital gains tax on. So that's how the qua legatee rule works. It's effectively a form of holding over. The legatee holds over any gains that were accrued during the personal representative's ownership. An issue that sometimes arises in practice is the question of who is a legatee, so who benefits from this rule. Now, section 64(2) of the 1992 Act gives a definition. It tells us that a legatee is any person taking under a testamentary disposition or under an intestacy. And in most cases, that will be straightforward. In the simplest case, a testator will make a specific bequest of an asset to a beneficiary, or the asset will form part of somebody's residuary estate, and it will be clear who the residuary beneficiaries are. Those people are clearly legatees. The types of cases where issues arise, well, I often see two types of case where this issue arises. One is to do with will trusts. So where a testator establishes a trust in their will, there is a question there of who is the legatee. Is it the trustee of that will trust or the beneficiary? And the answer is it's the trustee, and we'll see how that works in practice in a moment. And the other case where you often get difficulties are where beneficiaries have to make balancing payments. So where they have to pay a little bit of money to the personal representative in order to acquire the asset. So let's start with will trusts. Let's say that in this scenario, a testator has left a will in which they have given a specific asset, which has a value at their death of £100,000, and they've directed the executor to give this asset to their trustee, the will trustee, and the will trustee is then to hold this asset upon an interest in possession trust for the beneficiary. Now, let's say that the question that arises is who is the legatee in this scenario? Well, let's say that administration continues for a couple of years, and then the personal representative is ready to assent this asset to the trustee and thereby constitute this will trust, this interest in possession trust. And by the time there is an assent to the trustee, the value of the asset has increased by £50,000. Now, I should say in practice, the personal representative and the will trustee is often the same person. But because they're wearing different hats, executor versus trustee, they're treated as a matter of law as being two different persons. And it's helpful to think of them as two different persons. So when the personal representative assents this asset to the trustee, and that happens, they can assent, if they are the same person, they effectively assent it to themselves, or if administration of the estate has completed, their capacity changes, they change from personal representative to trustee. So it's sort of an assent by law. That assent to the trustee takes advantage of the qua legatee rule. Excuse me. So the trustee takes qua legatee. That means that although there is a disposal, it doesn't trigger a charge to capital gains tax. However, the trustee acquires this asset at the death value, that being the personal representative's base cost. So the base value for the trustee is £100,000. Let's say that under the terms of this trust, the trustee is holding this asset for the benefit of the beneficiary for their life, but the trustee has an overriding power of appointment. And again, this is quite common in modern will trusts. And let's say that a year after this assent, the trustee decides to exercise this overriding power of appointment and appoints the asset outright to the beneficiary. Now, at that point, the beneficiary acquires the asset absolutely as against the trustee, and that will trigger a charge to capital gains tax. And importantly, the beneficiary does not take qua legatee. In a sense, the qua legatee exception was wasted when the asset was assented to the trustee. It was the trustee who took advantage of that rule, and now the beneficiary is not able to. So that assent to the beneficiary will trigger a charge to capital gains tax. So there will be CGT on the charge of £50,000. So what can you do to avoid this? Well, let's start again. Let's say that the personal representative is holding this asset during the course of administration, and administration is not yet complete. What the trustee can do is, before the asset is assented to anybody, and before administration of the estate is complete, the trustee can at this point elect to exercise their overriding power of appointment and appoint this asset outright to the beneficiary. Now, you might wonder, how is that possible? Because this trust has not yet been constituted. What exactly is the trustee appointing to the beneficiary? And whilst that's conceptually an interesting question, it's not one that seems to trouble the revenue. The revenue accept that that's possible. So the trustee can appoint outright to the beneficiary, and by doing that, the beneficiary becomes absolutely entitled to this asset. And in effect, the trust falls away. You just then have a beneficiary with an absolute entitlement to this asset. So that when the personal representative is ready to assent the asset or ready to complete administration of the estate, the personal representative will assent directly to the beneficiary. And because you have a direct assent to the beneficiary will take qua legati. So that will not trigger a charge to capital gains tax. The beneficiary will therefore take free of capital gains tax. It won't trigger a charge to capital gains tax. Again, the beneficiary will acquire that asset at the personal representative's death base cost. So should they then sell it in the future, they'll be looking at paying capital gains tax on any value above £100,000. Let's now look at the issue of balancing payments. It's best to just illustrate this with an example. Let's say that Sarah has died and her estate includes a painting that at the date of Sarah's death was worth £100,000. And let's say that under Sarah's will, Alice is a pecuniary legatee. So Alice is entitled to a legacy of £75,000. But Alice really wants this painting. So Alice gets in touch with Sarah's personal representatives and says, what if I pay you a balancing payment? I'll pay you £25,000, and in return, you can give me the painting in satisfaction of my legacy. And Alice is in a sort of hybrid position. On the one hand, she's clearly a legatee, but on the other hand, her position makes her look a little bit like a purchaser of this painting from the estate. Now, the revenue, well, you can probably guess which view the revenue take. The revenue's position is that Alice does not take that painting qua legatee. So if there's an assent of that painting to Alice after the balancing payment, she'll be treated as a purchaser from the estate, and it will trigger a charge to capital gains tax if there's any gain showing upon the painting. And the revenue cite a case called Passant and Jackson for that. The views of lots of commentators is that case is not actually authority for that position, but there you go, that's the position of the revenue. So if you've got a beneficiary who is thinking about making a balancing payment, check first whether or not the asset is showing any gains, because if it is, the transfer to the beneficiary will possibly trigger a charge to capital gains tax. In terms of what you can do in a scenario like this, I mean, one possibility, and you'd have to think through the other implications of this, is that Sarah's personal representatives may be willing to assent this painting to Alice, but subject it to a charge, so charges with the payment of £25,000. So it could be assented to Alice subject to a charge for £25,000. So effectively, when the painting comes to Alice, the painting is really only worth £75,000, and the estate replaces that missing £25,000 with a charge against Alice. And in that way, Alice is not purchasing assets from the estate in the normal way. So that's one possible way of thinking about how to avoid that type of scenario. Okay, let's talk. I'm going to try and stop talking in a moment because I've been going for half an hour, but I just want to say a couple of words about variations and disclaimers and the IHT implications for personal representatives. If the beneficiaries under a state want to rearrange their interests, what they can do within 2 years of the deceased's death is to effect a variation of the will or the intestacy under Section 142 of the Inheritance Tax Act. And the benefit of doing a variation in that way is that the dispositions that are affected by the variation are treated as though they're contained within the testator's will. So it's as though it's the testator themselves making that disposition. And there can be all sorts of benefits from this. Avoid people making pets. They can take advantages of various reliefs and exemptions that they wouldn't be able to take advantage of in their personal capacity. Now, normally variations don't involve personal representatives, and often the parties to beneficiaries under an estate affect these variations without any involvement of the personal representatives. It's good practice to inform the personal representatives because they need to know who to actually pay legacies and other assets to, but there's no necessity for them to be party to the deed. There is one exception to that, and that's where the variation might results in the payment of more inheritance tax. If that's the case, then the deed of variation is not valid, or it doesn't satisfy the requirements of Section 142 unless the personal representatives are party to the deed. So they have to be involved at that point, because of course it's the personal representatives who are going to be primarily liable to pay that additional tax. Their ability to object is limited though. If they're holding sufficient assets to cover that inheritance tax, they're not allowed to object, so they have to join as a party to the deed of variation. So scenarios where this can sometimes arise, let's give an example. Let's say that Albert dies, leaving his entire estate worth £2 million to a charity, but he's excluded his long-term unmarried partner, Jill, from his estate. So let's say that Jill threatens the charity. She says, I'm going to bring a claim under the 1975 Act unless you give me a share of the estate. And the charity agrees. So the charity agrees to give Jill the sum of £500,000. And they agree that the best way to do this is through a variation of the estate under Section 142. Now, what's happening in this variation is that assets which were going to an exempt beneficiary, so they're going to a charity, are now going to a non-exempt beneficiary in being redirected to Jill. And as a result of that, depending upon what reliefs and exemptions Albert's estate had, there might now be a charge to inheritance tax. And because of that, Albert's personal representatives have to be party to the deed of variation in order for it to be valid. Although, as I say, they have to join if they're holding sufficient assets. And a quick point about disclaimers. Well, there are two types of disclaimers that personal representatives have to think about. One is the disclaimer, the one that I think is perhaps more common and we're more familiar with, which is again under Section 142, and that's where a beneficiary under an estate disclaims within 2 years of death. Whoever the asset then goes to, so normally under a residuary beneficiary, it will be treated under Section 142 as that being the original disposition in the will or the intestacy. And again, that can sometimes result in more inheritance tax to pay, although it's quite rare for that to happen. It might happen, for instance, again, if an exempt beneficiary disclaims and the residuary beneficiary is a non-exempt beneficiary. So that's something that that would be an unusual scenario, but it's something that a personal representative would have to be aware of because they may have to pay more inheritance tax. A type of disclaimer in which personal representatives will be more involved with is a disclaimer under Section 93 of the Inheritance Tax Act. And I do see this from time to time. Section 93 is a specific type of disclaimer which exists for the benefit of somebody with a life interest under a trust. So somebody with a qualifying interest in possession under a trust. And what Section 93 does is it gives the life tenant the ability to disclaim that life interest. And it's quite an important power to disclaim such an interest because, of course, if they don't disclaim it, then a qualifying interest in possession is treated as being part of their estate for inheritance tax purposes. And importantly, the Revenue accept that where a life tenant was unable to disclaim their interest under Section 93, either because they didn't have the opportunity to do so, or they were unaware of it, or they were suffering from ill health and lack capacity, or it was in place for a very short time, then in those scenarios, the personal representatives can actually disclaim that life interest after the life tenant's death. And that's quite unusual because what the personal representative is effectively doing there is disclaiming an interest after it's already terminated on the death of the life tenant. But it could be quite a powerful tax planning tool for the estate. So just to give an example of that, let's say that Claire is married to Frank, and Claire's estate, which includes a half share of a residential property, Claire has left her estate, including that share of the property, on an interest in possession trust for her husband, Frank. And let's say that she's then provided that the residue will go to her nieces and nephews. And let's say that Claire dies in 2019, but prior to Claire's death, let's say that Frank has lost capacity, so he's suffering from dementia, let us say, and that he's gone into a care home. So he's not living at home, he's not benefiting from Claire's estate, and no payments from Claire's estate are made to Frank. And importantly, because Frank has lost capacity, he's unaware that Claire's estate has been left to him on an interest in possession trust. And let's say that Frank dies 10 months later. And as I say, by the time of his death, Frank is unaware of this interest in possession, and he's not benefited from this interest in possession in any way. Now, because he's had this interest in possession, as a matter of inheritance tax, for the purposes of inheritance tax, that interest in possession will form part of Frank's estate. And therefore, Frank's estate is liable. It's aggregated with Frank's estate. And what effectively then happens is that settled property utilizes part of Frank's nil rate band, which then is great for the remainder beneficiaries under this interest in possession trust, but not so great for Frank's estate, particularly if the beneficiaries of Frank's estate are different parties. Now, you might think that that's unfair because Frank never benefited from this interest in possession and he lacked the capacity to disclaim it. So what Frank's personal representatives can do in this scenario is they can, shortly after his death, and as soon as they've got authority, so as soon as they've got a grant, if they're administrators, or I suspect immediately from death, if they're executors, they can disclaim that interest in possession on Frank's behalf. And then it will be treated as having never happened. So the settled property would go immediately to the the remainder beneficiaries. And the IIP is not aggregated with Frank's free estate. So in other words, you claw back Frank's entire nil rate band in that scenario. Well, that's all I wanted to say this morning. This is my own disclaimer. Of course, this webinar is for educational purposes, so I'm afraid I can't take any responsibility for the advice contained in. But thank you very much for listening, and I'm happy to take questions now if there are any. Right, so Paddy Appleton has raised a hand. Joe, is there a way in which we can allow people to ask a question?
I can unmute individuals. I'll do that now, but there is a question in the box if you want to.
Right. Well, could I encourage participants to do that then? If you have a question, to type your question in the box, and I'll do my best to answer it. So we have Paddy. Paddy, would you like to ask your question?
How formal or informal does the assent have to be to pass an asset to the beneficiaries so that the sale can take place on their behalf rather than on the PR's behalf? Particularly of a house, say.
Yeah. It depends upon it depends upon the nature of the asset. So if it's a property, if it's land, then the assent has to be in writing. There've been a couple of cases in asking, well, what happens where administration has ended and the personal representative has not done a formal assent in writing of any land. And there's authority to suggest, well, that you can have an equitable assent so that the equitable interest would pass. And that seems to be fine. But if administration has not completed, the only way in which the executor can assent land to a beneficiary is through writing. For other assets, though, for which you don't have that formality requirement, assents can be informal. So they can be as easy as simply physically handing over. So if the personal representative hands over, a family heirloom, a pocket watch or something, then that will be an assent. Of course, it's good practice to do them in writing, but it's not strictly necessary.
Thank you.
Thanks. Okay, so we've got a few questions. So the first one, so did you say that Claire and Frank were married? Would there not be a spouse exemption applicable? Yes, good question. Well, in the example, I think I'd said that Claire and Frank were, yes, so in the example, so Claire and Frank are married. So yes, you're right. The spousal exemption would apply. So when the asset passes from Claire to Frank, but on Frank's death, that asset would still be aggregated with his estate. And because he's the second spouse to die, there would still be inheritance tax to pay if the assets in Frank's estate had a value over and above the nil rate band. Okay, the next question, if there are multiple beneficiaries, can one purchase the property? Yes, so if there's multiple beneficiaries, can one purchase the property? I think I think this then refers to the scenario where you have a house, for instance, going to 4 beneficiaries, and one of them then asks to sort of buy out the other beneficiaries. That's problematic for both CGT and stamp duty purposes, because that beneficiary, well, as we say, that the position of the revenue is they won't be taking qua legatee, because they're effectively purchasing, they're buying out the shares of the other beneficiaries. So, and also it's likely to trigger a charge to stamp duty, land tax as well, because you're buying out those shares. Or, well, I'd have to think through that, but I'd be concerned about the stamp duty implications of that. And again, I mean, one thing that you might possibly think about in that scenario is assenting the property to that one beneficiary, but subject to a charge for the payment of legacies to the other beneficiaries. The next question is there a time limit on section 931 claims? I assume that applies to section 93. So a disclaimer under section 93. Importantly, there's not a time limit on section 93. So if there's a disclaimer under section 142, then that has to be done within 2 years. But if a personal representative is going to do a disclaimer under section 93, so if they're going to disclaim a life interest, there is no strict time limit. It does have built into it, in a sense, time limits, because a disclaimer, I mean, you can't disclaim an interest if you've benefited from the interest, or if you've had adequate opportunity to disclaim it and you fail to do so. Because the longer the period of time, the longer this has sort of been in place, and either the life tenant or the personal representative has not disclaimed it, it starts to give rise to a presumption of acceptance. And as soon as you accept a gift, there's evidence of acceptance, it prevents you from disclaiming it. So whilst there's not a strict time limit, the personal representatives should be looking to disclaim it as soon as possible. So the next question, can beneficiaries use the principal private residence against CGT? So is PPR available if a residential property is sold and it's showing gains? So can you use PPR? The answer to that question is yes, you can, and it's provided in a statutory amendment to the 1992 Act, which is in section 225A. And what it provides is that there must have been somebody resident at the property, both before death and after death, whose interest in the property is equivalent to 75% of its equity. So for instance, let's say that I live in a house with my brother, and the house belongs to my brother outright. And in the will, my brother leaves the house to me outright. Now, in that scenario, I was living in the house immediately before my brother's death, and I'm living in the house after my brother's death, and I have an equitable interest in the property that's worth more than 75% of its value. So in that scenario, PPR would be available. The final question, I think has been answered, hopefully by the last answer. Okay, well, thank you very much for the questions. If there are any questions which come to mind after, then I'm very happy to answer them. Just send it by email. That you can send an email to the clerk's email address, and I'd be very happy to answer them in due course. But thank you very much for listening, and I'll say goodbye now.